So we understood from the last video that we saw that the Indian rupee is falling majorly because of the impact of CAD. Okay. Now before we move on to that, just a little brush up for your remembrance. After the Ben Bernanke speech, you saw rupee first hitting the lifetime low of 59.9850. Then you saw it crossing 60 up to 60.70. Then you saw it going to 61.20. Now, a currency to fall more than 20% in 2 years is a big deal. Okay. Why is it happening? We've understood because all the foreigners are selling in the debt market, in the equity market. There is a huge selling pressure because of which they're receiving rupee back. So if they have their equity, when they sell it, they get rupee. When they sell the debt, they get rupee. They convert the rupee into dollars, so they will sell the rupee and buy dollar. This is one of the most simplest way to understand as to why the rupee is falling. But the point out here is that every emerging market currency has fallen only 2 to 4%. Why is that the Indian currency is falling 9%? Okay, in the last 2 months. The point to be asked is this. Okay, so let me try and explain to you as to exactly what is happening. So like we discussed in the last video, the major reason why that is happening is CAD, which is current account deficit. Now point number one is to try and understand what is current account deficit. Current account deficit is nothing but you have excess import over export, which simply means, say for example, we are exporting something worth $1,000, but we are importing something worth $1,800. So we are exporting $1,000 worth of goods and we are importing $1,800 worth of good. Hence we have $800 of deficit. Okay, which we call as current account deficit. Please understand, first is this is deficit, hence it is minus, and second is it has to be repaid in dollars. Okay, now India has only $290 billion at this point in time under reserves, which as per the report that I read last said that this is only sufficient for 7 months of imports for India. Okay, so now the problem is that first is FIIs and foreign investors are pulling money out of the country. Okay, hence the dollar demand is created by them, like we learned in the last video. And over here we see that India also somewhere has a shortfall for dollar, which means India as a country in itself is also creating demand for dollars, which is why people are going ahead and giving negative views about the local currency of India, which is rupee. Okay, which is why you've seen that the rupee is depreciated 20% in the last 2 years, which is some serious move on the rupee. Okay, now what is happening is first we have more imports over exports, plus we have rupee depreciation. Now how is this impacting more? Let's say we were importing $1 worth of crude in the past, for which we were paying 50 rupees. Now we are importing $1 worth of crude for which we are paying 60. Hence our outflow on import has increased, but our exports have not gone up because the world somewhere is in recession and we don't have a lot of amenities to export to them, which is again pushing up the current account deficit for a country like India. Okay, now there are two ways where we can control this current account deficit if we've got to take care of the rupee depreciation. First is either we decrease our imports or we increase our exports. Now we've understood increasing exports become a little problem is because the world is in recession. Okay, decreasing our export can be one of the points that we can talk about, but let's try and understand what are we importing the most. So let's say out of the total that we import 33% crude and we import 18% of gold, the two major components that we import. Now crude again is a necessity, and hence trying to control on crude will become a little difficult. So whatever has to be done, probably to start with, will have to be done on gold imports. That's exactly what the government in India is doing at this point in time. So what are the steps that they've taken so far? So first we understood what is the reason. What is the reason for the currency depreciation? We said CAD, okay, along with selling by the FIIs and all, definitely, because of which the rupee is seeing this. Second, we are trying to understand is what are the steps that the government has taken. So because we've understood 18% of our imports are gold, they've started taking steps on gold. Now what are the steps that they've taken? They've increased the import duty on gold from 2% to 8%, which means now if you have to import gold, you'll have to pay a duty not 2% which was there earlier, but 8%. Okay, so in the last 2 quarters they've seriously hiked the import duty for gold, which has curbed the import of gold, which in turn helps on the current account deficit because somewhere you are reducing the imports of gold. The second thing that they've done is on gold, they've gone ahead and put 100% cash margin. Now what does 100% cash margin mean? Let's say for example a stock like Gitanjali Gems, okay, let's call it GG. Okay, so Gitanjali Gems in the past received an order from a client, let's say worth 1000 rupees. Now what would Gitanjali Gems do is import gold, okay, on credit, which was allowed, and this is how the industry used to function. Import gold on credit, give it to the client, take 1000 rupees from the client, and then pay to the person that he is imported from. So the entire business of gold import was working on credit. Now post this 100% cash margin, what has happened is now if Gitanjali Gems wants to import gold, we'll have to make entire payment for the gold that it is importing. So if it is importing 1000 rupee worth of gold, Gitanjali will have to make a payment of 1000 rupees. Please understand, gold is always imported in dollars and not rupees. Okay, so don't go on the wrong path on that. I was just using the term rupee to help you understand in rupee terms. Okay, so 100% cash margin has made sure that people who used to import gold on credit have started importing less, or probably over a period of time will impact their business a lot, and hence Gitanjali Gems has been hitting lower circuit since the last 7 trading sessions because of this 100% cash margin which is imported, which is put on people who are importing gold. Apart from measures on gold, few other steps were also taken to kind of curtail the currency movement. One of the most important one was the move where RBI actually went ahead and banned commercial banks to actually do trading on their proprietary account. Now what does this mean is bank has a treasury team which trades into currency. Okay, RBI actually went ahead and banned all these banks and asked them not to trade on their proprietary account. And hence, even if the bank is anticipating that the currency will fall and wants to take a short position, they will not be in a position to take a short position in the market, and hence this will reduce volatility for the rupee on the downside basically. Then SEBI actually went ahead and increased the margin for anyone who's not from the banking background or a non-bank trading in currency from 4% margin which it earlier paid to 8%. Hence SEBI increased margin by 100% for trading in the currencies market, which was a huge move again. The third thing that the RBI did was RBI actually went ahead and restricted the bank even for the currency account that they were managing on behalf of their client. So the RBI said that banks cannot have more than 6% of position on the total open interest in that particular currency, even if they're managing the account on behalf of their client and not their proprietary account. Which means say for example the total volume on the currency is 1 lakh, means that the bank cannot have more than 6%, which is 6 lakh more than, so the bank cannot have a position more than 6 lakh or 6,000 or 10 million, whichever is less. Okay, which means that first, bank cannot trade on their own money, which is the proprietary account. SEBI said if you're not a bank, first you used to pay 4% to trade currencies, now you'll have to pay 8%, which is a 100% hike. Plus now the bank says, okay, your own account is stopped, but the account that you're managing on behalf of your client, there also you cannot have more than 6% position on the total open interest. So the total open interest in the market or total number of contracts, let's say traded in the market are 1 lakh, 6% of that is you cannot have more than 6,000 contract position in the market. To put that in rupee term, let's say you cannot have more than $10 million worth of position in the market. So whichever is less is the position that you can take, the open interest or the money. The fourth thing that they went ahead and did was so if the bank is managing the currency account for the client, the limit was 6% of open interest. But if you are a non-bank trader yourself, so if you are an individual, you cannot have more than 15% of open interest or 50 million, whichever is less. That was another thing that the RBI did. The fifth thing that the RBI did was the fifth thing that the RBI did was RBI understands that the biggest demand for dollar is created by oil, because oil is 33% of our imports, and hence all the oil marketing companies who import oil will have to pay in dollars. Now, what used to happen in the past is all these oil marketing companies will ask for quote for dollar at multiple banks. Now what happened is, because of this, every bank that they are asking the dollar rate understood that this particular oil marketing company is going in the market to buy dollars. Hence there was automatically a long position created by those guys in their proprietary account in the dollar, and volatility was created. RBI said that now you don't have to go to several banks to get a quote. All the oil marketing company who wants to buy dollars for their import will have to go to only one bank, and hence curbing the volatility in the dollar basically. What has happened because of these steps taken one very good thing has happened is that the current account deficit last quarter of 12-13 was 3.6% down versus 6.7% in the previous quarter. Now understand, we are saying 18% of our imports are gold, and because of those rules implemented on the gold, we've seen this quarter's current account deficit come out to be 3.6% versus 6.7%, which was in the last quarter. So we've understood what was the problem. The problem was current account deficit. We've understood what are the steps taken. We've understood post the step being taken, the result is good, that the current account deficit has gone down. Now what more can be done? What more can be done to bring down our current account deficit, which will definitely have a positive impact on your rupee? Okay, first is increasing dollar inflows in the country. How can you increase dollar inflows in the country? By making sure that politically we are kind of helping investors gain the confidence that India is the destination to invest. So now you will see new policies coming out to invite more foreigners to put money into India. FDI limits will be opened up and things like that to attract dollar to your country. Second thing, which typically can be done and has been done in the past, is issue dollar denominated sovereign bonds. Sovereign bonds is nothing but the government bond. Okay, so we've done this in the past 3 times. Okay, what happens is when you issue a dollar denominated sovereign bond is people will invest in your bond in dollar as a currency. Just to help you understand when has this been done in the past, this will give you a little understanding. This is taken from a source to do with SBI. So we'd issued 1.6 billion worth of sovereign bond called as India Development Bond in October 1991, for which we were paying for dollar denominated currency 9.5% interest, and if someone was paying us in pounds, we were paying 13.25%. In 1998 August, we raised $4.2 billion through something called as Resurgent India Bond, where for dollar we were paying 7.75% and for pound we were paying 8%, and for Dutch mark we were paying 8.25%. And we raised 5.5 billion in October 2000, for which for dollar denominated bonds we were paying 8.5%. So if we do this, we can again attract dollars. Okay, I hope you've understood a little about current account deficit and why is it impacting the currency at this point in time. Thanks.